Are we?
Yeah, it's okay. Why don't we just move ahead with it then? Okay.
No, it's okay. Whenever you
No,
like.
no, Peter, it's great. It's fine. I wasn't ready for you. Let's see. I'll talk to my producer about that. Peter, thank you so much for joining us today. And
Yeah,
I
you're welcome.
read,
It's great to have you. Thanks.
yeah, I read the bio that you sent out, and I was curious, kind of pre-bio. How did you get involved in the trading industry? What were your early experiences? Who do you blame for getting involved as a trader? Whose
Yeah,
fault is it,
it's good to
Peter?
apportion blame, isn't it? Yeah.
Yeah.
Well, actually, in a way, I consider myself quite fortunate to be in this industry. For those that have been around kicking a tin can down the street for longer than me, but I really love this business. I fell into it almost by accident. But we're
Those
going
are the
back to the
best.
sort of
Those accidents are the best, aren't they? Because you're not out there seeking it, and it's almost like the universe brings it to you.
Well, I think that's true actually, Dale. I'm quite philosophical in that way, and I look back at it now, and I'm thinking, well, I started off at college doing graphic design, and ended up on a trading desk in the late '70s trading silver, during the bunker hunt stage, and we were market making. I was
Oh my
working
God!
for a,
You
I
just
was
put me
working
in
for
a
a,
you just
hmm?
put me in a time machine, Peter. I mean, I remember that era too, and I remember people. There were even silver coin bag futures back then during the hunt squeeze. So God, you were there during the historic move in gold. A lot of historical similarities. Afghanistan, Russia invading Afghanistan. Now it's Syria. Uh, Interesting. And they had to change the rules on the exchange because the hunts had been successful, so they changed the
Yeah,
rules, and that was $50 silver, right?
yeah,
You
that's it.
remember that day?
Yeah, oh, I do very much because well, Makata, actually was one of the bullion houses that were actually one of our clients, and we used to market make alongside them. I was trading for Billiton, BHP Billiton today,
Right.
but in those
Yes.
days, Billiton was actually owned by Shell, the oil company. In those days,
Interesting.
a lot of the big oil companies were buying into the metals business at the time, and yeah, so we were a subsidiary of them and market making alongside Makata. But the guy that was actually running Makata was Henry Jarecki, and he was the guy that sort of eventually persuaded the exchanges to actually lift all of the deposit rates, which obviously then at that particular moment the Hunt brothers were incredibly leveraged on their positions and they couldn't finance it. And then you started to get the natural unwinding of positions from them, and that
Wasn't it
created this.
also wasn't it also liquidation only? You couldn't get long anymore, so that was another rule that I think it
Yeah, you
was
could be right. I
besides.
can't remember.
Yeah, I mean they threw the kitchen sink to pop that bubble at them. So
Yeah, they really did. Mm.
yeah, so they were successful. Beware of
Yeah, they
central
were.
planners, right?
Yeah, I mean, it makes you wonder, if we never had a repetition of that actually. And recently, when silver in 2011 traded up towards $50 again, you look at the chart and you think, well, actually, we probably should have actually exceeded that old high. Gold exceeded its equivalent high during that time at 850. So, you know,
Right
um,
point.
and you tend to think, well, actually, silver should have done that probably as well. If you're looking at the big development of all these things going on, and that's an interesting point, that I discuss with some of our clients when we cross over from FX maybe into precious metals. But one of the big aspects with all of those historic events is that if you live through them, you really do gain an insight to similar things repeating over time, over that sort of period of time. You begin to think, oh yeah, there's great similarities with that, and you start to build sort of analogs in your mind about different events recurring. Maybe every situation is slightly different, but there's a certain similarity going on.
You have an analog in your mind, and I know you're going to be getting to looking for a commodity revival. But you talked about a price that I talk about. I think it was 880 actually. I don't know, 850, 880 in 79 or January 1980 for the high in the gold that stood for 20 years. And after this big run we had from 2,200 to 1,900, 61.8 back actually is right around that 880 level, which is a previous 20-year high. If you're looking for a revival, are you looking for a revival in gold before it gets to those levels?
Well, I think so. I mean, one of the interesting things about the precious metal side of things is that if you take a look at some of the key mining companies, and I mean, you know, we're really probably getting to get some really good history going so we can see what's going on. We need to look
at the stocks bottom before the underlying commodity.
Yeah, I mean, that seems to be the case right now, actually.
And we might have a live example of that happening now if gold takes out that 270, the 1070 low.
Yeah, I think, yeah. No, you're right, Dale. It looks like a bit divergence on the big stocks. What we want to see really to get a gauge on what the potential for precious metals are is to get, you know, go back to as much long-term data as we've got. And I think one of the longest, historically, the longest data set was always Home State Mining, but they got bought out, I think, about 10 years ago by Barrick. So that data sort of set got put aside. And
yeah, you know, that was the only stock that really worked in the 30s. I think Home State, so it was around that long, and I think even with the confiscation of gold, Home State ended up being a great hedge. I think it rallied 20-fold. During that time frame.
Yeah, I've got some history for that, and I sort of wanted to take a look at what Home State was doing. It actually bottomed in 1924 and then started this rise, and as it was rising into the Great Depression crash, it sort of had a small blip down, which was really just a blip, and then it sort of all started to go up and up, and yeah, we had something like a more than 10-fold increase. So
yeah. Hold on, Peter, I have to spray some Windex over my ticker tape machine. You know, I still use the ticker under glass. You know, I still have that on my desk. So, I also, from what you told me, which kind of runs counter to what a lot of technicians are saying, the Dixie, it just broke out. There's targets. A lot of people banding about 102.50 for a long time to fulfill it. 104. The Super Bulls are talking 120-ish, but from what you sent to me, you're thinking that we could be terminating or being close to terminating this dollar rally.
Yeah, I think so. I mean, one of the things that we're viewing the 2008 advance as is a counter-trend phase. And if we use, now we're tending to use logarithmic scales when we measure the dollar index, that upswing up from 2008. And if we start extending the initial upswing, which occurred when the dollar was bid up during the financial crisis sell-off, into the sort of October 08, March 09 period. If we extend those two very similar highs by a ratio of 61.8 on a log scale, we're going to get pretty close to where we were in March, which is just above parity, or just above 100, I should say. And then if we extend the slightly higher high in March 09, we can push up to 103 something. 103, I think it's 103.77 from memory. So, you know, these numbers are very important.
I'm sorry to interrupt, Peter, but do you know how to screen share? Perhaps we could get a view of some of the charts that you're looking at. You go up to the green box with an arrow. And
yeah, let me just put a dollar index chart up, and I'll show you what that measurement looks like. Yeah, that's a good idea. Yeah, I tend to think that that, amongst other things, means that we're likely to. Let's just do a screen share now.
Yeah. So you just
put this on. How does that feature?
Let's see. Give it a second. Okay, beautiful. It's up there.
Great,
okay.
Great.
We've got
it. So this is the measurement. I'm just going to put, this is log scale, by the way, so anybody interested in really working this way should be using log scale. The problem is that most of the real-time data vendors that we're using, you can use log scale, but they don't use, unfortunately, the fib projections, the extensions, and the retracement levels, they're not really working with log scale. So you've got a linear calculation on a log chart. Doesn't quite work. So that's a bit of a pointer I would make.
Okay,
to
so explain that to me. And you know, I've been in the industry for a long time, and I guess I'm just using. I'm not using logarithmic charts my whole career. Why is it an advantage to use logarithmic over linear?
Well, it's just that I think when you're looking at large price movements, you're going to get more accurate levels. The consistency will be more accurate over time. So they're not going to be revealed if you start to use linear on sort of large scale charts. It won't matter too much if you're looking at intraday stuff. It doesn't matter at all. But it's for those that want to sort of look at a big picture.
Yeah, so if you're looking at weeklies and monthlies and dailies, a log chart is better.
Yeah, you're going to find more consistency in those measurements than you would otherwise. So that's the real reason. But as I said, so for example, on this chart, you know, I'm setting in log scale, but I'm also putting my projections into log as well, so that they match up. And not every system does that. So you've got to be very careful if you want to replicate or duplicate what I'm doing, to make sure that your developers have got this right. Now, what I'm doing is I'm just taking this this October 08, March 09 sequence that I was referring to just now, and I'm just extending this by 61.8. So we've got these two numbers coming in at 101.60, 103.77. Now I haven't excluded the possibility that we can actually tip slightly up to those numbers. It's very possible that we could. And we're monitoring this on an intraday basis to see if that's possible. But at the moment, at least, the overall effect of the dollar is one where it is upward peaking. And from a cyclic point of view, that certainly seems to be the case. Now, I'm just going to show you a cycle chart. And let me just see if I can find that. I've got it once somewhere here.
So you were influenced by the Frost book. That's when you came to embrace Elliott Wave. Did that follow through to Robert Precker's teachings, or you know, there's guys like Neely, Neo Wave, and some people, you know, learn Elliott and they end up developing their own style. Is that what happened to you as far as your evolution as a knee waver?
Well, I tell you how I first started to. I was commuting into London, you know, on a daily basis to the trading rooms there, and we had little pocket transistors radios even then, and in the early 80s. And I was listening to Bob Beckman. Have you ever heard of Bob Beckman from Super Timing, which he wrote an Elliott Wave book, and he was actually on London Broadcasting Corporation radio station every week, and I used to listen to him, and he talked about the Elliott Wave principle. So actually that was my first introduction to this, and this was about, I think it must have been about 1983-4, and then I started to put it into practice on my own. We used to, you know, in those days we didn't have such sophisticated computers like we have today, where we could see all sorts of intraday data. So in those days, we had an alarm clock, you know, which would ring on the hour, and then we would take a quick look at the price data, or the real-time data on the screen, write it down. And we would keep handwritten sort of like charts on the Dow and the S&P on an hourly basis. And this was great practice.
I remember that. I carried a chart book around with me, Peter. Commodity Perspective. It had coffee stains on it, and you know.
That's it. I mean,
you had that book too.
Yeah, we used to order their charts, and we used to update them, of course.
They were just daily and weeklies. No one was doing intraday stuff, except guys on the floor were doing point and figure stuff on the floor.
Well, that's it, you know, and so therefore, you know, we were doing that pretty much hands-on. Another colleague of mine then said to me, "Oh, have you looked at this Frost Prector book?" And so I read that as well, and Yeah, it was. Yeah, it was a catalyst in a way. The whole thing, that whole period of time, was a great period to get involved in charting. We had at that time ACTA, which was a pre-runner to the Society of Technical Analysts in London, and I was a member of that. And one of the guys I worked with was a director of that outfit, so I was one of the early members. And we used to sort of bounce around a lot of different ideas at that time and drawing our own charts. But somehow, the wave principle, was something which really gelled. Now I started to, I was working with a lot of institutional and clients at that time, and built up quite a big contact base in that area. But the institutional clients were getting very, they're very demanding actually. They would say, well, look, okay, so you think the price direction is this way? I need to see some price levels. What do you think? And when I started to get my hands on Elliott's original works, he wrote the wave principle back in '38, and then he came out with the monograph, which was Nature's Law in '46. I reread that, and particularly Nature's Law, and it really did rhyme that the whole basis of the principle was based on the Fibonacci summation series. So I started, at a fairly early stage of really experimenting with that, and found that that this was giving me great guidance on the amplitudes of some of the moves. Now, up until that time, the Elliott wave principle was really working still with Elliott's original concept of using channels, parallel channels for each degree of trend, to try and get the idea of amplitude. And in fact, Elliott's original works was based on that idea, which some people are still using today. Sometimes it works, sometimes not, but we had to get into a phase where there was a little bit more consistency going on. And over time, using the logarithmic scale rather than the linear, seemed to bring up a lot more hits. So we tended to use that throughout every time period after that. I was going to show you actually.
Okay. Yeah, so you went through one heck of a process. You know what is kind of a mystery to me is how can a guy who authored modern day Elliott, and I'm talking about Bob Prechter, be wrong about a bear market in equities for so long? Because you guys are looking at the same things. Now there are other Elliottians that of talking 2,400 in the S&Ps. So how do you, isn't that really the issue with Elliott, is that there's always an alternate count?
Well, it is. It's a big thing. I'm actually, in my spare time, I like to reread some of the old works and look at the evolution of Elliott wave, how it was developed. I mean, one thing I always tell my clients and anybody interested in listening about some of the historical reference to Elliott's work is the fact that when you read the original works, you get this distinct impression that Elliott was a work in progress, basically. It
Yes.
really was a work in progress, and that when Hamilton Bolton took over in the early '60s, and he wrote a critical appraisal. If you read that, he was coming from a point where he was saying, well, look, there's something in this, but it's not like the Holy Grail. There is an area of interpretation which is...
Yeah, there is no Holy Grail, is there?
No, there isn't really, no. I mean, we have to be very pragmatic about that. I mean, there are some marvelous things which occur for each discipline, but Elliott wave is not a Holy Grail. It gives you a pretty good roadmap of what should develop. But coming back to your question about how different Elliotticians come up with different ideas, I think it comes down to the individual. It very much does, because if you've got this idea that you live through a period of time and you see this huge progress that we've had in stock markets, since the the modern era in the 1970s onwards, and you live all that, and you see the exponential rise in all of that, it's quite easy to start thinking in terms that, we're always looking for a terminal high, an Armageddon collapse. At some stage, the Elliott wave process brings you to that idea. But the biggest problem that you've got is that, unfortunately, the personality the preconceptions that we have get in the way.
Biases.
And the biases that we definitely have biases, and you really need to clean those out. You need to go through a complete clean out, of your character biases, basically, and look at it from a very pragmatic level. Now, I can only tell you that when clients are jumping on your backs and saying, "Hey, I need performance," it really focuses your mind, and you have to evaluate at every single level. And I remember doing this again, when the stock markets were topping out in 2000 and starting to look at that whole decline. Yes, there was good reason to think that there was going to be a very sharp decline. Probably at the beginning, we didn't truly know with great effect how deep that might go. But as the development of that pattern occurred, and again, if you compare the S&P and the Dow during that phase, even the Nasdaq, and you compare it to something like another Western market like London's FTSE 100, you get the very distinct impression, and from a modeling point of view, you can measure these in logarithmic scale, that entire decline into the October 02 lows, and for Europe it was March 03, they were distinctly corrective patterns, and you then had an immediate turning point there where you could say, no, this is a major low, the markets are going to subsequently trade into new highs at some later date. When can that help us, determine when can that be? And that's what we did. So I think that the reason why a lot of mainstream Elliott wave gets, the big picture wrong on a more regular basis because of this subjective process, and they're not using also ratio and proportion in quite the way that I like to use it in order to help us to ensure that we're not going off at a tangent. So I think there's a very distinct approach to ratio and proportion that we can use in so that we can.
That's something you developed. That's something you developed. That's a tool that you develop, isn't it?
Yeah, I think that I did develop that really, and I guess it's really I needed it because I needed to also have something very tangible to say, hey, no, that's exactly how the pattern, a requirement pattern of a particular correction should look. It measures perfectly, and that's giving us a big tip-off that we've got to start thinking and changing direction. Because as you know yourself, yourself know that at these big changing points when they occur, the mindset really is being dragged into the herd. You've got to be thinking really in a very stringent contrarian attitude, but you've got to be also knowing that that there's something tangible that gives you that bias to say, okay, I'm coming out of the herd, I'm not being pulled in this time, I've got to look at this. That is very much a corrective process, and we had that actually even after the financial crisis in 2009. We could measure the Dow almost perfectly into the March 09 lows, and we had a forecast back in 2004 which gave us the idea that low at that time would be the lows, and that pulls you out of the herding instinct. So that's these measurements are very, very important.
What is this chart that I'm looking at? What does it represent? And why don't you explain what we're seeing right here?
Yeah.
US dollar weekly, and these are cycles.
These are cycles, yeah. This is a cycle we've put up, and I think the community of cycle people, there's a lot of people out there who are really good and watching these cycles, and I like to occasionally log into the groups and see where things are developing from. But for me, cycles is a complement to the Elliott process, because quite often when I draw my medium or long-term projections for Elliott wave, the price and amplitude aspects which are basically embodied into the wave principle itself are very accurate at times. But what we do find the problem, unless we use cycle theory, is that we're way off on the time cycle. So I like to play along with some of the more, let's say, mainstream cycles in various different asset groups. And here we've got the dollar index showing up. This is actually an 811-week cycle. So 11 weeks, we're talking about 15.59 years. And that's a general cycle. It measures from peak to peak or trough to trough. So if we want to sort of look at what we call a centrally translated cycle like this, where the peaks and troughs are alternating almost evenly, we just divide that 811 weeks, or that 15 point whatever year cycle by 2. So we get a peak to trough of about 7.8 years. So this is what you're seeing here. So we go back to the top left, and here's the top in 1985. That was when the dollar index was above 160. Now, for those of you,
that was the Plaza Accord.
Right, exactly.
Right?
Exactly.
Yeah.
Yes. And we topped out there. Now, actually, that cycle was a long-term cycle, which dates back to the greenback when it was first accepted as the main dollar currency after the American Civil War ended. So you're going back to the 1860 period there, 1863,
Wow.
1864. And that was the peak. That was, this movement up from the late 70s into that peak was actually the fifth wave. And we can see a very nice 5-wave advance from 1864. But this particular cycle you can see is repeating, and we've got a 7.8-year low into this period in when was that?
I think, Peter, tragically, I think Americans were too busy killing each other to trade currency back then. What do you think? Huh?
Well, back in 1860s, yeah. I mean, it's remarkable, actually. Do you want to see? I'll show you after this if you're interested, and we have time. I'll show you what the dollar index looks like from that low. But just to
but to me, what you're showing here is now we're entering a topping phase of this cycle in the dollar, and guesstimate on time frame for this peaking is what, into year end here?
Yeah, it's into year end. So we are looking at a time fuse now, which is quite short in order to get that reversal. Now the question is, do we actually punch slightly above the March highs or don't we? And we're covering that in our short-term work. But in principle, when you look at this, it tells you that even if we do punch above the March highs, we're not looking at anything that's a runaway move. We're not looking, as you said earlier, some analysts are talking about even 120. Well, that's just way off the cards. That's not, that to me is off the Richter scale. That's not really possible with this cycle.
Also, I think if you knew nothing about the chart or what it was, you could say that each recovery in the dollar has been weaker.
That's right. Yeah, you've got declining highs. And that's very much epitomized in the long-term decline. Actually, from an Elliott perspective, let's take a look. I think we've got that on my system here somewhere. This is the okay. Yeah, let's go. Now this is. Can you see this one, Dale?
Yes.
This is the really long-term stuff.
Yeah.
Actually, the data on the bottom left goes back to 1660, so we're quite fortunate to have this. But I'm just going to put a vertical cursor here. This is when you guys were killing each other.
Yeah.
And then we get this
Civil War. So is the U.S. the only example that the Civil War was bullish for its currency? Because in the modern era, it usually isn't.
Where the what was?
But the civil is the U.S. one of the only historical examples of a bull market of the currency of a country in the Civil War, because in the modern era, anytime there's social unrest, it's usually a currency crisis, not a bull move in that.
Well, I think
country's currency.
Well, this is so long term. This is an annual chart. If I just move my cursor just a couple of points along here, there's not. You can see it collapses during the American Civil War here.
Right.
So it was probably up at 44 and it went to 22, so it halved basically.
Yeah. Those were the good old days. Yeah.
Yeah, yeah. So actually, in here you've got a very inherent sort of 5-wave process in Elliott. You've got your. I mean, this is. I always show, clients this because basically we get a lot of questions about the fact that does the Elliott wave process degrade because of exogenous events, and I'm saying, well, actually. No, exogenous events may amplify a trend that's already existing. We have to determine. Sometimes they can change direction, but sometimes they the general concept of the idea of 5 waves in progression, 3 waves in regression basically holds up even through some time frames like this, because we've got, okay, the low kicks off at the time when the American War just finished, the American Civil War. But then you look through the time phase here, we've got the second phase of the Industrial Revolution. We have what I call the fall of the Eagles, which is the European monarchies all disintegrating in the early part of the 1900s. And then we get World War I, we have the Great Depression, we have World War II. I mean, how many things do we look at during that whole period? And nothing,
Wow.
in this type of model has been changed at all. And what's even remarkable is, if I go back to putting my fib ratios in, and I want to measure the typical fifth wave, one of the most typical things is you go 1 to 3, add to 4 like this, and there's the top. So, we've got, on a quarterly closing basis, that is, a pretty decent top there. And that's remarkable, really. I find that, just amazing.
Yeah, the harmony of the universe.
Yeah. I mean, why not? In a way, this entire decline, the regression model of 3 price swings, hasn't finished. So when we go back to sort of looking at the dollar index over a time period like this, here's your declining highs that you mentioned earlier.
Yeah.
And why not? Because this is wave A. We expect eventually wave C to get down to these numbers into the early part of the next decade. So yeah, I think what's interesting is, over the last 12 months in particular, a lot of mainstream investment banks have been talking the dollar up almost, in perpetuity, and I think that's really very misleading at the moment.
And isn't it counterintuitive that when we're maybe finally going to see an interest rate hike out of the Fed, and still more talk from Draghi of more QE coming next month, that it's almost classic that all of these supposedly very bullish events for the dollar are coming near a cyclic peak?
Well, that's right, and it makes you wonder, doesn't it, whether or not also interest rates can kick on up, or whether they just fade and die again. Actually, we haven't broken out of any significant ranges for quite some time, so we still don't know the answer to that unequivocally.
So Janet Yellen may not be the Grinch that steals Christmas. To me, I don't know if you've noticed it, every time the S&Ps are under pressure, they speak like doves, and every time it's threatening new highs, they talk like hawks. You think they're writing options? They're doing strangles?
Yeah, it could be. Actually, I wrote about it in my last piece, exactly, because we actually, in terms of the stock market, we don't know whether an interest rate hike is good or bad for the stock market at the moment. One minute, we like it because that means there's a fairly robust US economy going on, and the next minute we don't like it because that could set off a whole chain effect of interest rate rises. And a couple of banks last week said, well, look, if we get one in December, you're probably going to get another 3/4 of a 75 basis points throughout the entire year that follows, and probably successively for 2017 as well. That would end the era of low interest rates. So we don't quite know how to treat it. The only thing is that with the dollar and the cycle peaking, you get the distinct impression that whatever the outcome, is going to be bad for the dollar. At some stage this thing's going to fold down. And that brings us to the outlook for commodities too, doesn't it? Because we've been seeing them killed over the last 4.5, 5 years.
Yeah, what's most that kind of makes sense, a dollar peak and a commodity bottom. What is confusing, because how correlations change, like after our crisis in 2009, the bottom of the S&Ps happened with a top in the dollar. The dollar broke 20%, S&Ps rallied. It was more nominal, and the dollar down was risk on. What's your best guess for dollar down? Is it going to be risk on or risk off in equities?
Well, my guess is that the dollar will have to trend downwards, but I don't know about the relationship with the S&P. I've looked at that over time, and it does change. So my original hypothesis of the stock market, actually going back to late 2010, was that we said that at that time, there was a very strong interlink between the way that the dollar was behaving, stock markets, the dollar was treated as a basically a safe haven currency. And even, you know, if you look at the Canadian dollar pair, you could say that there was a very distinct, you know, sort of situation there where commodities were sort of aligned to the Canadian dollar. We were basically looking at the US dollar as that safe haven group, but that sort of basically that Canadian dollar US dollar thing broke down completely with the S&P, mainly because commodities started declining. So here you've had recently when we started to get this big acceleration up for the dollar in June last year, but I mean, actually we haven't seen a corresponding decline, have we, for the S&P? It hasn't happened. So you can't say that the dollar move up during that phase was safe haven buying, because we haven't really seen during that first interval phase up until May this year any S&P decline. So I tend to think that we are in a very important topping area for stock markets at the moment, and back in 2010 I did think that we would see these numbers at 2140 or thereabouts, because we extended the initial upswing in 2011 by 61.8. We could probably look at that to get those numbers, but last year, in fact, it was about a year ago, that I decided that because of the commodity situation, you've never seen historically commodities go up into another phase and stock markets collapse in a generic secular bear trend. That's never happened, and I don't think it'll happen this time. So when I show you this chart on the S&P in a second, this was my original hypothesis. Let's have a look at it here. Yeah, I think this will do it. This is my original hypothesis in 2010. And what I did was I took the 2011 upswing like this, and I extended by 61.8. And you can see, bang, it comes right into that May high. Can you see that blue line?
Yeah. Yep.
How that extended. And so we said, right, well, that measurement is basically used for a 3 price swing correction, a zigzag, like this. And the consequences of that placed within the larger aggregate move would mean that we go through an Armageddon-style secular bear trend. But when I looked at the commodities and the way the dollar was pitching up, I've later transplanted this scenario into a situation where I think that the stock markets are likely to trend down until probably about March, April next year, and then they're going to observe this number by trading downwards below the August lows into April next year. But then I think we're talking about after that another big leg to the upside, and this is what I've been talking about most of this year, actually. So
okay, so this could give us a blow off to 2400 after we flush out some longs under the August low, is your bias now.
That's it, and I tend to think that 2400.
And commodities will lead it, because we're going to have a weakening dollar. So maybe it's more like nominal terms of growth in stock prices because of the depreciating dollar, like it was after the low in March 2009. And commodities rallied then too.
That's it, so because, if the stock market goes through another gyration and we start making, higher highs at some later date, the pressure's off, the dollar's not in demand, I think it will, then there's not going to be, the dollar could be weakening as well, where commodities go up, stock markets go up, and they go up together, basically. And we make new record highs. Then the question is just how far do we make record highs? That's another question. But
right. What a great interview.
Yeah.
I feel like after talking to you, Peter, I feel like Nostradamus again.
Well, yeah. He there was never any proof really that he but then again, you can read what you like into it, isn't it? But that's an interesting one. No, I think that we're making interesting times. I just don't think that at the moment, from when we look at the fundamentals, maybe the drivers underlying some of the markets, that we know all the facts at the moment. I think there's probably going to be some emerging things happening next year we haven't yet considered that are not necessarily being talked about too much at the moment. I think we could be in a situation where central banks will come together and they will probably look at maybe stock market declines into early next year, and then they'll say they might panic a bit. They might start then a more coordinated run together.
They're already panicking. So the only one that would need to panic again would be the U.S. Fed, because we're the only ones talking about tightening. So maybe what you're talking about is that Janet does go ahead in December, and then ends up having to do a trichet by April, a reversal of policy, because the S&Ps are trading 1,700 or 1,600. What do you think of that?
Yeah. No, I think that sounds really good. I think that they could do a one-off just to settle the market for New Year, and then they start looking elsewhere, what's going on in the world, and that's been obviously in their notes in the FOMC meetings, that they're concerned about other areas of the globe, and then in the end we don't end up with any more rate increases at all, and we flop down. Then they panic.
It's interesting you bring up April. You don't know how many interviews I've done in the past several months of people that come from different disciplines of methodology, and a lot of people talking about April for maybe highs in the stock market or lows in the metals, but April seems to be an important month for 2016. Why is it for you?
Well, when we take a look at some of the other cycles on the commodities, we can see them nudging out a bit. I mean, oil nudges into the first quarter. I have to say that I use April because we've got the we're coming late March, early April. We're in this sort of spring equinox, and we've seen reversals then, obviously in stock markets before. So I'm sort of.
I'm sorry to interrupt you, but am I looking at a potential 4,500 S&P? 43.97.
Yeah, actually, if you're going to look at the S&P, the best fib ratios are coming out on the Dow. The reason for that is because if we go through an inflation pop where commodities are going up, the dollar's crashing down, we're really talking about something much bigger than what we could imagine theoretically. And of course, what I like to do is I like to bring something very pragmatic along with the fib price ratios to show that we've got something which is.
And your guesstimated target on that chart was 16.9 approximately for this last pullback before we go. Yeah,
that's right. Well, I think the S&P will, if we get back into the first quarter of next year, down to 1,700 again, and then we start to really push on. But
I got it.
One of the things which, in answering the dislocation between commodities and stock markets last year and this year in the discussion with our clients is that, well, you needed to say, right, well, look, if the dollar's going to start moving down for about 7.8 years now, and we're going to see commodities bottom out, and we're going to get this big push on commodities, a complete U-turn coming through. Stock markets can't go through a secular bear. Then if they're going to evolve from 3 price swings, which we currently have, into the May highs from the March 09 lows, they're going to evolve into 5 price swings. What are the targets? Let's use our generic targets that we've used over the last 20 years. Let's use this technique of Fibonacci price ratios, and let's see just how far we can go. So if you take a look at this Dow chart, which is going back to 1932, and we augment the decline from 2000 up here, 11,750 into the March 09 low at 64.70, and we label that a 4th wave. If we do our generic patterns for a 5th wave, then what we're going to do first of all is we're going to go back to the origin of that 5-wave sequence, which is 1974. And we're just going to do a very basic measurement here. So I'm going up 1 to 3, add to 4. And that produces this number at 41,982. Wow. I mean, when I did that, okay, if you use just one singular method, that's not necessarily meaningful. Okay, so what we're going to do next is we're going to try and verify that by going into one larger degree. And the inversion of 61.8 is 1618. So what I'm going to do now is it's obvious that we've got, if we are going to go to such measures, this entire 5-wave process that you see here is much larger than, say, the 3rd wave, which is this point here. So let's just mark that up as well. It's much bigger. And that tells us that if it's much bigger, the 5th wave, we've got to use an inversion of the fib price ratio. So what we're going to do is we're going to go back to the 1932 low, and we're going to come here to 1974. We're going to extend that by 1618, and you can see the projection comes in an exact overlay match. Now that's the type of thing I'm looking for in order to get the next big target numbers. And there's one last one we can do also, is if we extend wave 1 like this up here by a 1618 ratio. Now I admit I'm fudging this slightly, but I'm getting into a 3rd ratio. We normally do this for, we commonly extend the 1st wave by a 1618 ratio. So you're getting all these 3 things converging up at anywhere between, sort of 42,000. I think we're entering a new era. I think if we can get commodities turning around with the dollar in the next month or 2, and showing this big change of effect going on.
Well, I mean, maybe we could label the new era the dollar losing its reserve currency status if we're going to 50. Maybe it's China's going to get what it wants, and there's competition for the dollar and flows out of the dollar into maybe the yuan, the euro, gold. Commodities rallying is not exactly a vote of confidence with your outlook in the dollar. Perhaps there are some major events like the IMF changing the SDR, China setting up its own institutions outside of the World Bank, and I've been reading about they're developing their own SWIFT system. Russia as well participating in that. So perhaps this political struggle that we're seeing showing up, manifesting in boats and planes passing each other, and an expansion of Russia's role in the Middle East, is also about the dollar losing its luster and no longer being king dollar. What do you think?
Well, no, I think any of those could be triggering certain things. I mean, this whole Asian bank process has been going on, and a lot of the US is saying to the Europeans, why are you signing up for that? I don't think the Europeans have got any choice but to sign up for that sort of Asian banking system, reserve banking system. They have to keep their trading partner groups on an even keel. But definitely there's been talk about that dilution of the dollar as a reserve currency. I don't think that people have talked about for many times about the fact that the euro will go to the wastelands, but we always need an opposite currency to the dollar to trade against it. As traditionally we used to trade cable, didn't we? Sterling dollar. Well, it's still up there, but nothing like it was. Sterling.
So we're probably talking about a 180 euro. If this scenario unfolds over the next several years.
Yeah. In fact, I think we've got something like 210 even, eventually.
210, and we're probably talking about gold taking out its 1900 high, huh?
I think so, yeah. I think that's possible. The thing is, if you've got all the commodities that are capable of turning around and even taking out, to new highs, then we've got maybe out of the list that you mentioned, and the topical subjects that we've got to think about is whether or not inflation actually eventually could start to filter through, rather surprisingly.
Yes.
That would
and then the Fed is behind the curve.
Then they're really behind the curve. Yeah. Then they're really we talked. Yeah. Then we call it. Well, then we got to look out for breakouts on the the 10-year yields and things. Then we're not looking at the yields just being in a benign state of affairs. Then we're talking about traditionally, though, of course. And one of the things that we can also take a look at is the correlation between yields and the dollar. Generally, I think, including myself, and I'm at fault for this actually, is that I always assume that if the 10-year yields are trending up, the dollar goes up. But actually, I did a chart recently, and it's not always the case.
Yeah, not in a currency crisis with a depreciating currency.
That's right. So, you might find that China's dumping its bond holdings,
Okay.
which in effect would raise rates if they
Yeah,
have
so
low confidence in the dollar.
right. So we could have rates skyrocketing without economic growth because there's too much supply and people are liquidating their holdings, and the size of offerings are not increasing. They have to decreasing, but they're increasing because rates are going up, which puts us into a situation where servicing the debt becomes more difficult. Um, this has been a great macro presentation. Could you wrap it with your view on gold? I know we have some people who say don't wait to buy gold and wait. Interested in perhaps where and if you think is a good area to begin accumulating the gold.
Well, I think if you're not leveraged, that is, you can begin right now. But I've signaled there's two significant levels that we signaled earlier this year for gold. One was, well, both basically broke $1,100. So we had signaled originally 1077 as being an important low, but I'm beginning to think that we might have a little touch down to 1050, 1052. So that's my next big downside number.
Yeah,
That's
that's
not
my
far
favorite
off.
formation, Peter. On a weekly, I really like looking at three drive formations. They don't with divergences developing, and that would satisfy it 1050, 1030.
Yeah,
Um,
there's some nice fibos down there. Some nice fib price ratios down there. Before I just sign off on gold, this is Newmont Mining, and this is one of the
okay.
reasons why I think that we could be involved in something to do with inflation, what I call inflation pop, because this long-term pattern is very interesting. It's you wouldn't believe that we topped out in 1987 and have never been above it since. This is one of the big gold miners in the world. We've got three price swings down. In Elliott terms, we call that a zigzag, and then we get this swoop to the upside. And that swoop to the upside is, since 2000, and when was that? That high was in 2006. We've been unfolding in what Elliott calls an expanding flat, just a correction to the move up that preceded it from 1275. Well, that pattern in this expanding flat means that we've got to break above the old highs at some point. So we've labeled
So
this.
time-wise, because you're not calling this the ultimate low, you think that happens down the road, but you're looking for a nice, what, like 1 year move or so to the upside?
No, I think this will go into the next part of the decade. I should have stretched this out. We've got a minimum time phase of May 19, about 2019. But I think
Okay.
this could last into a bit longer. But the main thing is that what this demands is a massive move up, and we've got again a convergence of price ratios coming in at 166. So we're looking at a tenfold increase. Now I think
Okay.
that's amazing. That is amazing.
Well, that's
Uh,
like the 30s, like what
yes,
Homestake did in the 30s.
exactly right. Yeah. So I think we're staring down the barrel of something like this. So I'm thinking that there's somehow inflation's got to be linked to this. Gold won't just do a counter trend bounce, from the 2011 drop. If this is going to work, and I think I assign a very high probability to this outcome. So I think that gold's going to have to break the old highs, and in the short term, we'll just finish then with a look at gold and maybe this low down at
And then
10.
I want you, if you can, to show your website and how people could follow you, get involved with you. Do you teach, Elliott, and get to your business model that you have?
Oh,
Okay?
great, thanks, Dale. Yeah, no, thank you very much. That would be great. Well, just yeah. Then the final chart really to look at is gold here, and this is typically what we call a wedge-shaped 5 price swing event, and yeah. So if we haven't already finished into July, this could stretch out a little bit low into year end, down to this 1050, and I love the ratios here because again, if we stick the 61.8 levels in and we just go down to the first wave here, extend that by 61.8, it projects this line here, and if we go down to this initial drop this year into the March low and extend by 61.8, we get another overlap going on. So that's where the $1 differentiation between those two levels come in. And I really like it when you get those types of things happening. That gives us really generally very good signals.
You look for confluence of your work coming together, and it gives you more conviction about an outcome.
That's right. I think it would do. You know, if you get what I say is a price reversal signature at these levels, it gives you a lot of confidence about what you're dealing with, because you've got something tangible. You know that you know, arbitrarily this is just an arbitrary number, but it's not when you put the numbers in. If you measure the ratios, then it's no longer arbitrary. There's a specific reason why the price would stop dead at that level and turn around. And if it does that, then you know the effect is more likely to change direction of the trend. So you have a lot more confidence to edge yourself into that time period. So that's good.
Yeah.
Yeah.
Great. Yeah, that was great, Peter.
Thanks, Dale. Thanks a lot.
Thank you for sharing. I mean, really, you know.